But let's continue the conversation in the meantime with Evercore ISI Senior Managing Director Julian Emanuel. Julian, great to have you back on the show. The S&P closing at 4365. It's continuing this recent rally up 4 3/4%, just over the past week. You have a year-end target of 4450. You confident we're gonna continue higher from here? And if so, what makes you confident?
Yeah, we feel pretty good about it. First of all, again, the seasonality is definitely a positive. Even in bad years like 2022, we saw that seasonality in November off of the October low, and we think we're seeing something similar to that. But again, if you look at it, basically, people have came into November defensively positioned, and probably rightly so when you think about the geopolitics, the political ramifications, and the fact that earnings likely look unchanged year on year. But all of that having been said, the fact that the 10-year bond yield moved away from that psychologically important 5% level is very, very positive bomb in a world where stocks and bonds tend to move in a correlated fashion.
Yeah, and we saw a lot of short covering in the bond market as well last week. To your point, Treasury is going to be selling tens of billions of dollars worth of notes this week, so that I'm sure will be key for investors. But just looking at the market, where would you be positioning right now? Do you stay in some of these big, what we've been calling the more defensive Magnificent Seven or big cap tech names, or do you look elsewhere in this rally?
So I would really call it, Morgan, a barbell approach of sorts, okay? So we did some work. We believe the last Fed hike in the series was July the 26th. And what our work has shown is that the time between the last hike and the first cut, which we don't think comes till mid next year, there is a definite propensity for the defensive sectors. We think healthcare is most attractive in that category to outperform. So we think that healthcare has been very largely unloved. It tends not to care about how interest rates move around. It tends not to care about geopolitics. We like that sector, but at the same time, we also think the AI type themes, those names that really have benefited, are likely on a medium to longer term basis to continue to work higher. That's an ongoing theme for us.
Okay, Julian, picking up where Morgan left off there, part of the reason why names in healthcare haven't been loved is these weight loss drugs, GLP-1s, they're threatening everything else, or at least in investors' imagination, they are. So I know you're screening for stocks that perhaps have been unloved in this GLP-1 dominated environment. How are you looking at value there, and how long a time horizon do investors need to have to make sure that they have the stomach to deal with them?
So whenever you're buying something, and the small cap performance today really is a dramatic example of that, if you're trying to buy something that's been beaten down, you need to take a cautious, considered approach to it. You don't buy all at once. You perhaps scale into a position, understanding that trends don't change on a dime. But from our point of view, when we look at the sector, there are a number of stocks whose valuations are really near sort of 5-year lows, at the same time that they are expected to grow earnings next year in excess of the index average. And we think that's a very compelling setup, particularly when you look at healthcare's overall valuation being substantially beneath that of the S&P 500.
Okay, and similarly, there's been a lot of excitement around AI, but that cuts both ways. If you're not a semiconductor name with a clear play there, NVIDIA, Supermicro, the WCLD is still under 30, at around 28 today. So how are you, even among the smaller names in software, distinguishing between what might end up in the trash heap and what's real value that just hasn't been recognized yet?
So I think there, again, what you have to sort of look at is what the earnings trajectory looks like into 2024, and in fact, was into 2023. And obviously the bias for the names that have a larger exposure to generative AI in one form or another are likely to continue to outperform. But again, and if you think about the market as a whole, we've had a very good rally over the last week. We've had, if you think about it, a very good rally from the October lows, but there's still potentially a period of economic weakness ahead of us sometime in 2024. So you don't put all your eggs in one basket. You hold a little bit more cash. There's no penalty for holding cash at 5%, as Berkshire Hathaway told us about that over the weekend. But you have to be a very patient, long-term investor and let these themes play out.